Let's now turn to self-managed super funds and the key considerations perhaps that investors should be aware of in that space. Marjon Muizer joins us from Red Willow Super. Marjon, thanks very much for joining us here.
Thank you.
Look, self-managed super funds are becoming more and more popular. Why is that?
I think probably one of the main reasons is the level of control that investors have, because I guess you can just decide specifically what investments you choose to have. So probably one of the main reasons is that people want to take control of how they invest their super.
Now, when we talk about setting one of these up then, compliance is a key. What are the key considerations there?
There's a fair few actually. So generally trustees, they would have an accountant that prepares the tax return and the financial statements at the end of the year. And then they need to appoint an auditor that's independent to the accountant and the trustees to review the compliance side of things. And then if there's any potential breaches, the auditor has to report that to the ATO. And the compliance considerations, they really depend on the different investments that you have. So they're both investment related, but they're also linked to like when you can access your super, like how much money you can take out, how much money you can put in and so on.
Could you give us some examples there when you say it depends on those investments you have?
Yeah.
What sort of assets are you talking about?
So like let's say if you have a property, like a residential property or a commercial property. So residential property you can have as an investment, but you can't rent it out to yourself or someone that's a related party of you. So for example, a family member or maybe a business partner. So one of the things the auditor would look at is who you're actually renting it out to. So they'd ask for a lease agreement, and they would also check if it's leased out on commercial terms.
All right, so that's property. How would you treat, for instance, shares, maybe even private equity?
I think some of the more sort of standard investments like cash and shares, they're quite straightforward. It's more like the unlisted ones, like investments in private companies and properties and loans and so on, that are a little bit more complex, because a lot of the tax concessions in super, they're linked to how much money someone has, like the member balance. So that means you need to, one of the compliance rules is, for example, that you have to value all your investments at market value at the end of the year. So if you have a property, it means that you need to provide a valuation each year annually, and there might be a cost associated to it, or you might need to put in a bit of work to compare like data on what would support the property value. And it's a little bit similar with investment in private companies. Like sometimes it can be difficult to find adequate evidence to support what it's worth. And usually it means you need to liaise with the company and see if you can get some data on comparable sales, for example.
So you use the example of investing in property. Aside from who you can lease it to, obviously in unrelated parties, what else do you need to consider when perhaps purchasing a property for your SMSF?
Yeah, I think before making any investments, it would be good to have a chat to someone, because quite often people hear that in investments you can invest in almost anything in an SMSF. So sometimes it's quite easy for people to get excited about maybe investing in things like artwork or crypto or all sorts of things. But then I think it's always a good idea to just have a chat to someone like an advisor or an accountant and just ask what the different compliance considerations are for those different investments.
And obviously there are also the tax considerations as well.
Yeah, so when it comes to property, for example, like you can also borrow in super to purchase a property. So that's something that is probably becoming a little bit more common, but you do need to look at whether or not it's a good idea, like if it's better to maybe hold the property inside of super or outside of super. So generally the tax rate in super would be a little bit lower. So that means if you sell the property or when you get rental income, probably you'd get the tax rate would be less compared to if you'd own it personally. But then, like if you're selling the property or when you're getting rental income. But then at the same time, like let's say if it's a geared property, so you have a loan, normally you can claim the interest. So that interest deduction might not be worth as much in super compared to maybe outside of super where your marginal tax rate could be higher. So I think you need to sort of look at the overall picture from a tax point of view.
Now, potentially there are some regulatory changes as well. What do you need to be? What do you need to consider if you are have an SMSF?
I think the changes in super, they seem to be kind of ongoing. Like it's sort of important to keep up to date and make sure that that you're aware of that. But at the moment, probably most of the rules relate to like how much you can put in and how much you can take out. Because in the past, because the tax concessions were quite generous and have been for a long time, it means that a lot of people would put significant balances in super, and that's now a lot more restricted. So there's caps on how much you can put in, and also there's caps on the tax rate that applies to certain balances.
Marion, let's go back to where we started from and talking about the popularity of SMSFs. Is there a particular age or a time in life, or perhaps when you're starting a family, whether you've just started a job, that perhaps it makes more sense to have an SMSF? Or what would the advantage perhaps of staying in a retail fund be?
Yeah, I think it also depends on how interested you actually are in managing your own investments, because even though you can get the help from an advisor, you're still ultimately always responsible for running the fund and also the compliance side of things. So you need to be willing to set some time aside. And another consideration is probably, like, there's the cost also. So there would be a cost to establishing a super fund and maintaining it. But generally the cost for a self-managed super fund might be a little bit more fixed in nature, perhaps compared to other funds, because you need an accountant that prepares the return, and probably it doesn't make too much difference if you have 10 listed shares that are worth $50,000 compared to 10 listed shares that are worth a lot more. Like, the tax return is gonna, like, the work that the accountant has to do, it's fairly similar. And most of the time with industry and retail funds, you're charged a percentage of your member balance, whereas usually in an SMSF there tend to be more fixed costs. But in the end, it still also depends on the the help that you're getting with it. So if you're liaising, if you have an advisor to help you out with making investment decisions, then clearly there's a cost for that as well. So some trustees that are quite knowledgeable, they don't have an advisor, they make their own investment decisions. But I would say the majority probably get some level of support from a financial advisor.